Hey everybody, welcome back to another episode of Two Takes. I'm Chad Riedlinger.
And I'm Howard Vernick.
We are here to talk about everything mortgage and real estate.
So it looks like first-time home buyers are getting younger and they're ready to buy. Obviously, we're talking about our millennials. Studies are showing that at least 8.3 million first-time home buyers will enter the mortgage market between 2020 and 2022. And if there's exceptional economic growth, we'll get 9.2 million. Either way would be a significant acceleration from the 7.6 million first-time homebuyers added between 2016 and 2018. It looks like the primary motivations are that they want more privacy, they want to build equity and build wealth. A lot of them are getting married, and a number of them are expanding their family. What's your take on this?
So what does it all mean, Basil? This is all the same stuff that we're talking about all the time, right? So they want more privacy, they want to build wealth, getting married. So this is like the millennials are no different, in my opinion, than home buyers 20 years ago or 30 years ago. Like they want the same thing. And, some of the things the article referenced about, home ownership rates are down right now, and then we're going to see daylight because of slowing home price appreciation, low unemployment rates, increased wage growth, and low rates. Like to me, this just means that we're par for the course. Like it's just the same stuff. Like millennials are no different.
This is a lot to do about nothing.
Right.
This is kind of a waste of an article. I don't even know why we chose it.
So there is one. They said the one thing I did like about the article is it said the top delays. So it said 58% of people said that the biggest thing that delayed them were not having enough money. But of those 58% of people, 50% of them thought that they needed 10 to 20% down. So I think it's a lack of educating the home buyers.
Right. I think that we all, not just the young people, but even older people, we have to increase the financial literacy and long-term planning. And home ownership is a great way to do that because you can leverage the purchase up front by borrowing money. And there's no other investments really that you can do that.
And also, I see you, Paulie. I see you, Paul. That's okay. No, but the other thing is, like, when you see all these advertisements online, Quicken Loans, push button, get mortgage, they're just advertising the speed, but they're not taking time to educate the borrowers, which I think is part of the reason that we're still have so many buyers thinking they need 10 to 20% down and pristine credit to qualify.
I agree with you.
So next article here, we got several banks have committed to return to FHA lending. So I took this one out of Housing Wire. However, this was all over every single publication, right? So that HUD reached an agreement with the DOJ to decrease the use of the False Claims Act, which basically was used to punish lenders doing FHA loans, and Wells Fargo basically became the whipping post. Whipping boy, whatever they call that. Whip something. So Howard, what's your take on this?
Well, this is great for consumers. The banks getting back in the business makes more competition, lowers prices for everybody. Although I don't think the banks are necessarily going to be a heavy player.
Right.
I think the reason that most people don't take an FHA loan is because they can't qualify for conventional financing.
Right.
You can get 3% down. And the big culprit here is the mortgage insurance. The 1.75% up front, the 0.85% per month, that unless you put a bigger down payment, you're going to keep that for as long as you have the loan.
And that all started when FHA was running through their struggles, right, financially, and they were like, hey, we need to get paid for the life of the loan. And so to your point, everyone wants to go conventional if they can. And quite frankly, I don't know if this is going to really be that much of a difference because the banks typically weren't wanting to do FHA loans anyway. They were even making a lot of them were making portfolio loans. So they were still lending to these borrowers. Do you see it being any more competitive in the landscape for direct lenders like us or mortgage brokers? Like, do you think that Bank of America, Chase coming back into the mix with FHA is going to make our jobs harder?
I don't think so. I think the top tier customers who can go anywhere for financing are not going to go FHA. Because they're not going to want to pay that mortgage insurance.
Right.
So it'll be some, and we'll deal with it. We've dealt with it for so many years as in the past, so we'll deal with it again. So burned in 2008, Americans are refusing to tap their home equity.
I thought this was an article about me.
Right.
I was headline reading. That's my article.
So it
I was
looks
born in
like
2008.
right. So
Anyways.
it looks like before we had the financial crash, there was a lot more people out there who had home equity lines of credit. And I think that we saw that when they came and foreclosed on homes, and they saw the RV, they saw the toys, the boats, the planes that people
Lamborghini,
have.
yeah,
Right.
yeah.
And today, people are just not taking the equity. So is it good, bad, good for the economy, bad for the economy?
Well, I mean, the way I looked at it was, well, first of all, congratulations to Americans potentially learning from their past mistakes. Like, they were using their home as an ATM machine before, and obviously got burned from what happened. But now what I did read, though, is that it said HELOCs doubled in volume from 2003 to 2006 before the crash, and then HELOCs have fallen by almost almost half in the past decade. So really, we're just back to where we were before we became greedy and thought that there was no end in sight for the appreciation of all these homes. And so I don't think that this is a big deal. I do think, though, HELOCs can provide a really good source of, just a good tool to have for people to be able to use instead of using credit cards or instead of going out and getting personal loans.
No, it's great. I think everybody who has equity in their home should take out a HELOC. Just don't take the money out and leave it there for a rainy day. Don't go buy the new car or boat.
It's like when my wife buys Oreos and says, just get the Oreos, but don't eat them, Chad. They're for the kids.
Right. And this to me goes back to the financial literacy, is plan for the future and use your home wisely so that you can have a retirement. I think those statistics are horrible about how many people are retiring with no money or can't retire right now.
Absolutely. Well, homes, real estate is still the number one generator of wealth. Last but not least, Howard, were you surprised to read that less than half of borrowers are happy with the mortgage process?
I got to tell you, there was 500 people that were polled. I wonder where they got those people. I was greatly surprised because most people think that getting a mortgage is worse than going to the dentist.
Right. Yeah. So, well, I thought it was only 47. Well, it said 47% were satisfied, which I was like, wow, that's pretty good. Because again, I think like most people look at buying a home like buying a used car, like the process sucks, right? So, so really to break it down further, 18% didn't like the credit analysis, right? So they don't like going to the proctologist. 13% processing difficulties. So what I thought when I read this was like, let's focus on what we can control, right? So we can't really control the fact that we're going to analyze their credit. But what we can control is the 13% thought that processing difficulties were an issue, 10% were appraisal issues, 4% didn't agree with income calculations. So I'm like, okay, don't worry about the 4%, just educate them. But the 13, the 10%, I think we can do that by setting better expectations.
Well, I think the real answer to anybody who's not happy with the mortgage experience, and for us professionals who are in the business to give them a good experience, is to do the pre-approval before they ever start looking.
Absolutely.
Analyze credit, income, and assets. Give it to an underwriter to look at. Don't have just the mortgage person look at it because, there's all varying levels of expertise and of experience.
And we're salespeople, so we approve.
We like to say yes. And then once you find a property, if you have an unusual property, like a condominium or a rural property, or the property has a lot of land, or the property's in disrepair, understand that there's going to be some hiccups there, and it's going to take a little extra time, and let the borrower understand that so that it can expect something's going to happen. And then finally, when people are making offers on houses, have the realtor show them the comparable sales, the closed sales, not the listings that are wishing to get that kind of money. Yeah. And of course, unless you're in a declining market, and if it's declining, then you want to look at the listings so you can kind of see where values are going and what kind of offer to make. Yeah. And that'll help your appraisal issues.
Yeah, I mean, I think, and it all comes back to setting good expectations, and that TBD underwrite, I think, is huge.
It takes all the guessing out of it.
Absolutely. So that's our show for today, guys. We really appreciate all the good support that we've seen online from the episodes that we're putting out. If there's anything out there that you guys want to hear us discuss on Two Takes, please just drop a comment below. We'd love your feedback, and we'll see you guys again
next week.
Have a great day.
Take care, guys.
Bye-bye.